Welcome to another instalment of the D. Walter and Associates Education Series. Today we're going to talk about share purchase and key person insurance. So look out, business owners or even self-employed people, the key person stuff could be for you. So first of all, share purchase insurance. This means that the partners of a business own a life and TPD insurance policy on the other owners, on the other business owners. So that if something happens to one of them, the surviving partners get the cash, and the family or the estate of the disabled or deceased partner or business owner receives a fair and reasonable price for their share of the business. So an example of that is a business here valued at $4 million with four owners. So each partner is insured for $1 million of life and total disability insurance, and it's owned by the other three partners. So if one partner dies or becomes totally disabled, the three surviving partners receive their $1 million. And the important part here is the agreement between all of them. So it makes it very, very clear that the surviving partners must buy the share off the deceased or disabled member, business owner, and they must sell to the surviving people for the agreed price. Just makes things nice and clean and easy. So how does it work? You can see here on this diagram the sum insured, who's insured and who the owners are. We've assumed here that owner or partner number one has died, so the other guys, the three remaining, receive the $1 million, and they pay that $1 million to the estate or family of the deceased or disabled person, and they must sell it for $1 million. So this is crucial to avoid business disruptions and potential disputes. I mean, no one wants to continue a business with a grief-stricken spouse of a now deceased partner, or heaven forbid a 19-year-old child comes in. There's nothing they don't know, so therefore you're going to be that's going to be creating a lot of tension, and it would seem that you could end up doing the surviving or non-disabled partners will continue to do all the work, but all of a sudden they're only getting 75% of the revenue. So it's really, really important to get this stuff, get your ducks in a row. So what are the benefits? As we kind of went through. All right. Moving on to key person. It provides the lump sum if a key person dies, is totally disabled, or they suffer one of the listed traumatic or critical illness events, with the main ones being cancer, heart attack, or stroke. So there's two types of cover. So there's the capital. You can use that to repay debt or any other capital expenses. The payout for this one is tax-free, and you don't claim a tax deduction for the premiums on the way through. And then there's revenue that replaces the lost revenue, the salary, cost of finding a new employee, and then you need to gross this one up for tax, because you'd be claiming a tax deduction on the way through, and the payment will be taxed at the 30% company tax rate. So here's your example here. Let's assume same deal again. There's four key people. The business has $300,000 debt, and they would expect that if something happened to one of them, they'd be away for at least 12 months from the business, that they'd lose about $500,000 in revenue. So what happens here in this case is, for the key person capital, each partner is insured for $300,000, and then for the capital purposes, and then for the revenue purposes, each partner is insured for $1,075,000. This is how it works. So the capital value, the key person capital to start with, there's your sum insured there. Let's assume key person one, and the owner of this policy is the business or the partnership. So Sadly, key person one has been diagnosed with cancer. The good news is the business receives 300,000 and they can use that to repay the debt. So not only is the business now debt free, but it really frees up the cash flow. If a key person dies or is totally disabled, or they have a traumatic event, the traumatic event, they're going to be pretty cooked for 6 to 12 months, but they're going to come back. So that's a decent stopgap there. So the revenue, here's how the revenue works. So they're insured for $1,075,000. Same deal again. If key person number one and it's owned by the business, same deal, same person, same scenario. The business this time receives $1,075,000, and the reason that it's up to that amount is it covers off on the $500,000 of revenue that's been lost. Or let's assume $200,000 as a 12-month salary, $50,000 of recruitment costs, and then we need to gross it up for the 30% tax, which is around about the $325,000. So that is how you get through the 6 to 12-month period of readjustment or return to work when if a traumatic event happens. So how can we help you? So we assess your business or partnership needs, help you actually land on a valuation for the business. We provide advice documents that clearly outline what you need and the insurance solutions that go with that. We ensure that the insurance providers have the definitions and the competitive premiums that meet all of your needs, and we utilize a lawyer to refer you to ensure that your share purchase agreements are executed legally and everything's above board. And on an annual basis, we review what the business value is and what the insurance cover is, and ensure that it still is doing what it's meant to be doing. So that's essentially it for the share purchase and key person. So if you want to know more, get in touch with us today, and we can certainly run through the scenario with you on what we think is going to make sure that everyone is protected and the business interests are protected as well. So thanks, guys. Have a great weekend. I'll be back next week. I've loosely put in here boring but effective, which is kind of what I believe we do. So watch this space for what that actually means. Cheers.